Hello and welcome to an introduction to technical analysis, module 3, topic 2. We are discussing the misinterpretation of the 200-day moving average. And in this topic, we're going to show you how to correctly interpret what the 200-day moving average is suggesting. So let's get started. In a bull market, when prices are rising and increasing, it is important to understand that the 200-day moving average will act as the major support of a market. Now, in the previous topic, I mentioned the misinterpretation. And this misinterpretation is as follows. You will often hear pundits and investors talking about a break of a 200-day moving average. When we talk about a break of a 200-day moving average, particularly when it's rising, we are finding a situation like this blue circle, this blue highlighted area, where prices break the 200-day moving average. At that particular point in time, you'll often hear these guys talk about the market has now changed direction, it has broken through its rising 200-day moving average, therefore they consider that as the new bear market. But we need to put this into perspective a little bit. And by putting it into perspective, we've got to use a little bit of logic. Firstly, how long is the 200-day moving average? Of course it is. It's 200 days. So now we're talking about one day that breaks the 200-day moving average, and all of a sudden it's a bear market? No, the markets don't work that way. In order for a bull market to change into a bear market takes time. It evolves. So understanding that one day breaking a 200-day moving average, it's impossible to change the direction of that moving average. So it's incredibly important that when we interpret a bull market, we interpret the 200-day moving average within the bull market, that we look at the overall direction of that moving average. In other words, if that moving average is pointing upwards, meaning positive, sloping positively, we are in a bull market, regardless of whether we have 1 or 2 days or even 3 or 4 days that are trading below that 200-day moving average. So if I take you to the highlighted areas in the chart in the slide, we'll see that we have one area over here that the market broke its 200-day moving average. Now, we can see clearly that that certainly doesn't look like a bear market. It is still a rising 200-day moving average, meaning the primary trend is still bullish. And here again, in the last quarter on this particular chart, prices broke the 200-day moving average from above. People often are talking about a bear market at that stage, but clearly the average is still pointing upwards, sloping positively, so we are still considering that as a bull market. Now, when we're looking at defining this bull market and understanding the 200-day moving average in this bull market, there are a couple of ways that we can see this. Joseph Granville, a great technical analyst, spoke about 4 different ways to interpret a 200-day moving average within the bull market. The first one, of course, is that the 200-day moving average needs to flatten out or advance following a decline of prices, as well as the price of the instrument that penetrates that moving average. So, for instance, the moving average was pointing downwards. It starts to slowly flatten out, which means that prices would have had to break that moving average from below, remain above that moving average, move back or pull back towards that moving average, and then bounce off that moving average, which will then change the slope from flat to advancing. The second way that we can interpret this 200-day moving average, according to Joseph Granville, is that if the instrument, the price of the instrument, falls below the moving average while that average is still rising, this also constitutes an area where you should be looking to buy the market and not sell the market. The third way, of course, is that if the instrument, the price of the instrument, that's trading above the moving average, but it declines towards the moving average, but fails to penetrate it on the way down and rebounds on the way up, meaning that it is acting as a support level, this also constitutes a really wonderful area where you can take advantage of the renewed primary trend market. And the fourth way, of course, is that if the price of the instrument falls too far, too quickly below the rising moving average, a short-term rebound to that moving average is highly probable. and this also constitutes a good area to be buying that market.